Welcome, everyone. I'm Casey Snyder, and I'm joined today by Tom Sidoric.
Good afternoon, everybody.
And on behalf of everyone at Clove Hitch, we want to thank you for taking the time to join us for our 2025 Outlook semi-annual market update. Based on positive feedback or the positive feedback that we've received, we're continuing with these webinars because of how we know how helpful they can be, especially for those who prefer a more visual format. So today's structure will feel similar to those in the past, where first, Tom and I are going to look back and reflect on the past 6 to 12 months. Second, we'll provide some valuable context about today's markets. And then finally, we'll share some key themes, or what we believe are key themes as we look ahead to the future. And assuming compliance approves, a recording of this webinar will be made available for replay, and we'll send it out via email to all those who are in attendance today, as well as to those who are unable to attend. And then, as always, we'll conclude with a Q&A session. And for confidentiality, we ask that you use first names only when asking any questions. With that, again, thank you again for joining us, and we'll get underway here. So, Tom, we're going to start by looking back, and we are going to begin actually with the same page that we started with back in July, but it has since been updated, discussing U.S. equities. And their continued dominance, or the continued dominance of the Magnificent Seven, I should say. And as we mentioned back in July, the concentration and appreciation within tech is on a scale never before seen, with its relative performance surpassing the highs set during the dot-com bubble. Right, so the magnitude and length of this rally within the Magnificent Seven is rare. And what you can see in the upper left-hand corner here, you can see the calendar years 21, 22, 23, etc. You can see in gray the returns of the S&P 500 as a whole. But when you break it down, the S&P without the Magnificent Seven here in light blue, up 17, down 8, up 8, up 10 last year. When you focus on just the Magnificent Seven, you can see some pretty dynamic numbers during the up years, as well as an unpleasant number during the down, and really the share of total returns that the Magnificent Seven makes up. So when you think about 2024, outside of the Magnificent Seven, it was a very average year. And then on the right-hand side of the page, what you can see is the unique concentration in the S&P 500 over here at about 39%. So the top 10 companies make up about 39% of the S&P. Tom, we've talked about this quite a bit. Concentrations aren't all that uncommon, but this one's a little different because of the tech exposure. Can you share a little context or speak to that a little bit?
Sure. I don't think we've ever seen a time in history where concentrations have been quite this dominated by one sector, which is technology. I think we can understand the reasons. We all have in our pockets, in our cars, technology is all around us and constantly evolving. But it does help us beg the question is if you own an index fund, which many folks do, and many are proposing that that's a good way to own the market, are you really owning a diversified holding? Is it diverse if it's dominated by, 7 or 8 technology companies? And I guess the answer is probably not.
Yeah, there is a piece this week, Tom, from Bloomberg that referenced how narrow this market was, meaning that only about 20 to 25% of the S&P actually outperformed its respective benchmark or index. And the last time we saw such a narrow market was in 1998 and 1999, sort of to your point about the concentration. So, however, returns have started to broaden. And we saw this in the back half of 2024, at least through the end of November. December, things reversed course a little bit based on concern about tariffs, etc. But again, we're seeing this in January, where the broadening of returns is happening as investors, to your point, we just mentioned, investors are rotating out of those concentrated indexes and into other areas or other cheaper sectors of the market. We're seeing this especially in small caps, and in value. And Tom, something we've been talking a lot about is how the small cap market, the Russell 2000, for example, how its dynamic has shifted some because of how private equity is now playing a role, again, as we look back, and how it's kind of restructuring the small cap market a little bit.
No question. I do think that this broadening market and the breadth improving is a healthy sign, but it hasn't totally helped mitigate the risk that the Magnificent Seven represent.
Right. And I think we're going to come back around to some of that private equity and some of these other opportunities in a minute. Tom, we're going to move away from equities. We're going to look back, and we can't look back and not talk about inflation. Okay. Inflation comes up in I don't want to say every meeting, but a lot of meetings. And so we think it's worth a few minutes. And as you can see on this page, this dates back to January of 2018. What you can see on this page is that inflation is normalizing. It's moderating. And if you look at the various colors here, you're seeing the energy spike during COVID. Energy is coming down. You're seeing core goods in orange come way down, as well as even shelter, despite the high cost of whether it be renting or buying. But again, to note, just because inflation's moderating, it doesn't mean that things are becoming less expensive. It just means that merely they're rising at a slower pace. And this was something that we spoke a lot about in 2021 and 2022, because we talked about how the inflationary spikes during COVID. By the way, I think we started rebuilding our house right around here, which was a lot of fun. But the COVID-related spikes would eventually recalibrate and normalize, and they have. But there's one component within this chart that we do want to provide some caution on, and that is, in fact, the insurance line item here, this red. So, Tom, why don't you speak to the growing red in this chart and loop in the homeowner's insurance element as well?
Sure. In case you referenced your house and the tragedy of your house burning down, thankfully nobody was injured, but you lost everything else. And we've been talking about insurance for quite a while with our clients about, is their coverage adequate, or if they got replacement costs covered? And you now see it in this chart. And I don't know where you found this, by the way, but this is an exceptionally good chart because it covers a lot of data in a very, I think, fairly simple way. But we've been talking to our clients about, we look at all the areas of risk that we're trying to help you manage, everything that touches your balance sheet and your home and your car being fairly sizable assets. Make sure they're protected, and the cost of that protection is likely to increase. We're seeing things like the California fires, hurricanes in Hawaii start to impact, homeowners insurance in New England. Automobile insurance is a national phenomenon, that's going up everywhere. So prepare accordingly and make sure you understand the dynamics of what's happening in the background. Part of this was fueled by low interest rates for so long, and now I think a lot of it's being fueled by climate.
I remember speaking to a principal of a regional insurance company in 2022, and he candidly just said, look, people forgot how to drive during COVID. So it led to a whole lot of accidents as everyone kind of came out and went back to their more normal lives. But you mentioned interest rates, Tom, and that's a good bridge, unless you had something else to add there.
Well, I do think the size of the vehicles is another component that's been coming out in the insurance world. So, we drive down the highway, we look at the mass of some of these vehicles, and that's another reason the costs are increasing.
And the technology within it.
Yeah.
But so you mentioned interest rates a second ago, and that is a transition into this next page. And we can't talk about inflation without talking about interest rates. And this chart shows the Fed funds rate dating back to 1993. All right. And what we can see here, the rise, okay, the fall, the rise, the fall, the pronounced sort of fall here, and then the dramatic rise in 2022. And if we take ourselves back to mid to late 2023, the narrative at that time, again, mid to late 2023, was that interest rates would be falling considerably in 2024. And we cautioned everyone from buying into that universal narrative, because when everyone in the room believes the same thing is going to happen, rarely does it play out that way. And we discussed that on our webinar. And sure enough, rates fell much less than expected in 2024, and they didn't even start falling until the fall. And what you can see here currently is, market expectations. When we look ahead, you can see that markets are expecting, really, they're not expecting much as it relates to continued declines from here versus what the Fed continues to forecast. And so why does this matter? Well, it matters because the Fed funds rates are influential and really sets the tone for savings on cash, CDs, the ultra conservative slice of one's balance sheet or allocation. Low rates were essentially a tax on savings, while higher rates, like the ones we see today, compensate savers, which is a good thing, especially when you think about inflation being lower than the rate you're receiving on those conservative assets. So this isn't necessarily a bad thing per se for conservative savers. Anything to add there, Tom?
I think it's worth noting the dramatic rise in interest rates, particularly a couple of years ago. We talked about this on our call, a year and a half ago, when we were navigating this dramatic rise in interest rates that was supposed to happen over 2 or 3 years. It happened in, essentially 6 months. And how well we navigated that for clients and some of the tax opportunities that came out of that. I don't know that we'll see the same type of volatility in the bond market going forward, but we're ready for it if it comes.
Yeah, so again, great transition there. The next page here is a little bit more about the interest market and navigating a higher interest rate world. And so this page here provides an overview of the yield curve. And it's kind of the last piece of the puzzle between inflation and interest rates. And we want to provide a brief explanation because of how the yield curve either directly or indirectly influences everything from savings rates to mortgage rates, rates, auto loans, and really the overall cost of borrowing. Even the refinancing of government debt, which is, by the way, there's a lot of it, and we're going to get to that here in a minute. But a quick explanation of this, we'll do our best. The gray line here along the bottom represents what we would consider a normal yield curve, where you have short-term bonds paying lower rates than longer-term bonds, right? Because if you're going to lock your money up for 20 years, you want to be compensated more than if you lock your money up for 1 or 2. Now, granted, this gray line represents a very low interest rate environment, literally anemic. This was horrible. 20 years at 1%, nothing attractive about this. Fast forward to July of 2023, and you can see the green line represents an inverted yield curve. That's when short-term interest rates are higher than long-term interest rates, and it's a disincentive for investors to lock money up long-term. Why would you do that at 4% when you can make 5.5% in 6 months? All right, now typically an inverted yield curve has preceded recession. So this is often kind of recessionary red flag. Again, take yourselves back to 2023, and the narrative was, hey, interest rates are going to fall. Well, guess what? They didn't. Fall of 2023, interest rates were even higher. Here's the light blue line. It was less steep, so the inverted yield curve wasn't as steep and was starting to normalize. Remember, interest rates are going to fall considerably. Well, this is where interest rates ended at the end of 2024 in this dark blue line. All right. Why are we sharing this? Because Tom and I and our team heard a lot of last year. This was the narrative last year. Hey, I'm going to buy the home at the 7% 30-year mortgage rate, and when interest rates drop, we'll refinance. Well, they haven't. And if you look at the bond market today, and you look at the 10-year, which again is a heavy influence or has a heavy influence on mortgage rates, we may be looking at a rising interest rate environment. And to Tom's point a few minutes ago about harvesting losses in 2022 and the environment being different as we look ahead, we have been preparing for a higher interest rate, rising interest rate environment to some extent for the last few years. And that's why we wanted to share this with you.
And Casey, I think your understanding from your prior career in the mortgage industry allows you to help use the yield curve to the advantage of many of the young families we represent that are starting out, offspring of our existing clients, buying their first homes, because you understand what this dynamic can do to them. And in many cases, they can buy the right house for the right price. And I think in most cases, you've helped people try and think about the 30-year home, which is the right way to approach it.
Yeah, we may not, I mean, in 2004 and 2005, a 6% mortgage was normal. And we may be back to that environment, and the new norm may be even a little bit higher than that. Kind of stay tuned. So that brings us to the end of our looking back segment. And now we're going to spend some time providing what we believe is important context as we attempt to evaluate where we are today relative to history. There's a famous line by the legendary investor Howard Marks. It's that he's not in the business of forecasting. We never know where we're going, but we sure as hell ought to know where we are. So this is our attempt to try to provide some context. And we are going to begin with a chart that everyone has seen before. It updates monthly, and it represents valuations in the U.S., at least S&P 500 valuations in the U.S., with the context of history. And what you can see here in this chart, as a reminder, is the black line across the middle represents the trend line, okay, or the trend. And then you have these light shaded blue areas that represent valuations during different eras. Now draw your attention to the upper right-hand corner, the highlighted 187%. We had to title this page, we're going to need to rescale the chart soon because frankly, we are running out of room and territory. We are seeing valuations in the S&P to the likes that we really haven't seen before, especially as it relates to tech. Okay, and it's important to note because this is titled regression to trend. If we look back at some of the prior peaks, the early 1900s, there was in fact a regression to trend over time. Following the roaring 20s and the buildup to the Great Recession, there was a regression to trend. The 1960s led to the 1970s, which was a regression to trend. The tech bubble, the great financial crisis. I think everybody can see where we're going with this. What this is not, though, is it's not a forecast or prediction for an imminent downturn or a recession. We don't know, but what we do know is that these valuations are extreme and rich. Now, this is just the S&P 500. This is not meant to capture small, mid-sized companies, foreign companies, the bond market, and other areas of the market as a whole. This is just the S&P, and it's important to put in context where we are today relative to history. Tom, anything to add to that?
No, just a reminder to our viewers that markets can stay overvalued for a period. They did in the late 1990s, which we've talked about extensively from a historical context. They were pretty crazy in the 1920s, although I wasn't around. And they can stay overvalued for a long time, but they probably won't stay overvalued forever. And mean regression will occur. That may happen combined with some changes in where the mean is. The mean may in fact adjust because of this, but right now we know that the S&P is extremely rich.
Yeah, there was another line by Howard Marks that mentioned he titles it suspension of disbelief. I know it's high, but I don't think it's going to end tomorrow. That's kind of the line there. So now, Tom, part of the reason why S&P valuations are as extreme as they are because of some of the animal spirits we're seeing today. So the chart on the left shows the extreme optimism when it comes to investor expectations. All right, and just to reiterate, markets have a long history of climbing walls of worry. They don't have a long history of climbing walls of extreme optimism. So this is one of those red flags of going, wow, this is something to pay attention to. And we are starting to see some of those animal spirits firsthand, especially by those who haven't lived through a material downturn with wealth yet. And notice, we're not saying it is younger investors because over the last 10 or 15 years, a lot of newly created higher net worth investors have earned or inherited their wealth, since the great financial crisis. So this is really more of a matter of experience of once you've lived through a significant downturn with wealth, you don't forget it. And until many newer investors live through one, it's kind of hard to recognize what can happen or how things can change. Tom, on the right-hand side of the page, this is a chart that gives a sense of the U.S. options activity from individual investors. And you have a story about options. Why don't you share a little bit about what this chart represents?
Sure. Just remember, folks, that options are a derivative of an underlying security, typically a common stock, not always, but most of the time. And they're primarily used for two purposes. One is to hedge your existing position, protect its value. But the other is what we're seeing more of now, which is the rampant speculation. And the story that Casey asked that I reference is what I learned from my late boss years ago. He said, I want you to think about trading options as though you have a handful of $100 bills in one hand and you have your other hand on the toilet flusher. And you throw the $100 bills in the toilet, you flush, and options trading is the experience of how many of the $100 bills you can get back before they all go down the toilet. I think it's a pretty apt one. I don't know that most of the people getting into options now recognize the risks that they're getting entailed with, but they're going to find out, and it probably won't be pretty.
Tom, to that point, to your point about them being speculative, I remember speaking with my roommate in college. We went to school together. This was 1998. And I spoke to him right around here, and he was NYPD. And he mentioned how he picked up trading options as a part-time hobby during his time off. That was a little concerning, to say the least. But anyways, we move on. Kind of continuing with this extreme optimism and the excitement about the future, one of the primary reasons for such extreme optimism has been the excitement about AI. Now, we were on the cusp of a potential recession in 2020, was it 2023, when chat rolled out, I believe, and it's essentially AI in some respects may have thwarted a recession at that time. And there's no denying how AI may remake our day-to-day lives as we think about the future. There's a header or there's a small paragraph down here at the bottom from Vanguard's 2025 outlook, and it references, while they believe the adoption of AI will occur faster than prior innovations, they still don't foresee significant productivity growth until the late 20s at the earliest, 2020s at the earliest. So we think this kind of quote says it all. We tend to overestimate the short term and underestimate the long term. I think what makes this such an exciting story is that it's really difficult to quantify the potential of AI. If you take, for example, mobile phones, you could in some ways triangulate the numbers. How many people are there? How many people are likely to purchase a mobile phone? How often will they repurchase a mobile phone? And you could kind of get a sense of its impact. And even then, they grossly underestimated its usage. I say they, meaning investors in general. When you think about AI, it's hard to take that same approach because the narrative provides kind of a limitless storyline. It's going to impact us everywhere, per se. But just because we can't quantify the true impact of AI doesn't mean that it won't take time for productivity growth to work its way into earnings and markets in general. Tom, something to add to that?
Well, and I'm reminded, Casey, often of when we talk about AI, and I don't want to diminish its importance because it is significant. But I'm reminded of when the internet first became a big thing and how it was going to do away with my job, how it was going to do away with your job, how it was going to change the world. Well, the internet has changed the world, but in ways very different than what was forecast at the time. Many of the companies that were big in the internet space, whose names we might remember, Netscape, AOL, et cetera, but they're kind of in the dust heap today. So be careful about what you believe and how you use that to distribute your money. Because right now, AI is probably going to be big, but look for the companies that benefit from what AI can do for them. I think those are going to be the true investment successes in this, not per se an AI company, but a company that benefits from what AI can do.
And Tom, I think coming back to where we started, and you're starting to see that broadening of return or the broadening of returns because other companies are now involved in investing in trying to incorporate AI as it relates to productivity and growth, to your point. And some people refer to them kind of as the picks and shovels around the technology itself. So very exciting, but again, proceed with caution. Um, we are going to change gears entirely, and on a far less exciting subject, we're going to move into the subject of U.S. government debt and the U.S. budget as a whole. And a quick illustration here and quick walkthrough. On the left-hand side of the page, what you can see is total spending here in the U.S. based on the 2025 budget. What you'll notice here, net interest expense on outstanding debt is now 15% of the annual budget. You then have Social Security, Medicare, Medicaid, other mandatory items, defense, and then non-defense discretionary. Okay, for context here, this is the big one that we really want to showcase. For context, in 2012, this was $220 billion and made up 6% or slightly less than 6% of the annual budget. So for those who seek to slash spending by about 20%, this is going to be a very challenging effort, especially when the budget deficit itself is running approximately 28%, which is a staggering sum outside of wartime that, Tom, you're going to reference here in a minute. But now that interest rates are higher, we just talked about how higher for longer, higher rates being the new norm. The more debt that is accumulated, the more interest is owed. And the larger the line item is, the larger the percentage of the annual budget. And this can very easily turn into somewhat of a nasty feedback loop, especially when you think about $14 trillion of low interest debt maturing over the next few years that will need to be refinanced and now at higher rates. So Tom, the chart on the right gives you a sense of the federal net debt as a percentage of GDP. I just mentioned wartime. Why don't you speak a little bit to what makes this unique and concerning?
Yeah, we've talked about this quite a bit internally. We've talked a little bit about it with our clients, but what's unique about deficit spending now is that normally deficit spending is utilized in periods of economic distress. After wars, rebuilding your economy, certainly after World War II, we took on an enormous amount of debt on a relative basis. And we did rebuild the economy. We did rebuild the global economy with things like the Marshall Plan. But right now, we're not at war. I mean, we've got some minor skirmishes going on, but it's not like a world war is going on. And it's not like times are hard, but we're still spending in a deficit fashion, which is particularly troubling. So, what happens when things get really tough? What are we going to do? Because, as James Carville says, the bond market is going to dictate what we can and cannot do, and we may not have much latitude.
And Tom, to that point, that's why we titled this, the national debt may be the biggest potential shock. And we've talked to some clients about this over the last 2 months. The bond market, in many respects, may provide some checks and balances when it comes to the administration's economic agenda. The higher rates go, the higher the interest expense associated with the new debt that needs to be refinanced and more debt that is yet to be taken on. So this is a slippery slope, and the bond market did start pushing back right up front, which is why that yield curve we showed you a few minutes ago, that's why those rates have come up. It's concern about inflation and concern about debt. And the higher those go, the more of an impact it will have on folks, for better, for worse. So we're going to change gears slightly, but this is still associated with the last page that we just showed you. And this chart provides a longer term view of 10-year treasury yields. You can see the title on the top, 10-year treasury yields. And we may be in the early stages of what we would call a secular shift. And what we mean by that is, for most of you on this call, your norm has been an environment where interest rates and tax rates, for that matter, have been in decline for about 40 years. from 1981 to 2020, interest rates for the most part were in decline. Few of you, if any, were investors with wealth from 1958 to 1981, the last rising rate long-term cycle. And so 2022, taking the cursor right here, may have marked the beginning of another upward cycle. Great. So what does that mean? Well, a couple things. One is it means that the stock market-like returns within the bond market that many experienced over this 40-year stretch are a thing of the past. It also means that longer dated bonds, the 20, 30-year dated bonds, may be associated with much higher volatility and more risk than many investors are aware of. Now for the good news. Bonds are back to delivering and generating meaningful income streams, and are apt to provide a sense of stability when equity markets fall apart. They're in a position to play the role of diversifier while generating meaningful income, which is what we would appreciate, and it's what they're meant to do. And it's something that we've been preparing for, as we mentioned a few minutes ago, for the past few years. And for many of you, our rebalancing efforts within your respective bond portfolios have been geared or oriented towards this higher rate, higher inflationary world. Tom, anything to add to that one?
Yeah, I think the real message here, and this is a great chart to display it. I started my career in '84. Rates have been falling for a better part of that career, and you had to be an idiot to lose money in the bond market, and some people still did. Now, as you pointed out, Casey, we're probably in the middle of a shift, and you need to make sure your maturities of your fixed income are relatively short and intermediate. You don't want to stretch out for yield. People that do will probably pay dearly for that, and they may forget that bond prices move inverse to interest rates. So if 10 years from now you're looking at an 8% long bond, those 4% bonds you bought are going to be underwater by a fairly significant margin. So don't stretch for yield.
Yeah, well said. All right, Tom, that brings us to the end of our important context. We are moving into key themes for the future, at least from our perspective, and we are going to begin with an updated capital market assumptions, a guide for the future. This is a continuation. We've now had or incorporated capital market assumptions in the last two webinars. These are published by Vanguard, and we appreciate their approach versus others because of how they publish what they believe to be a range of potential returns, and they also view these as probabilities rather than certainties. And as you digest this, we know there's a lot of numbers on this page. I want to draw your attention to a few of them because of whether it be their importance or because of their popularity. So on the top half of the page, again, this is Vanguard's 10-year outlook. So it's as if we're having a conversation 10 years from now, and this is what they're projecting the results will be within different categories. U.S. equities as a whole, they're forecasting at 2.8 to 4.8%. That is well below the historical average of, call it, 8 to 10. In the U.S. growth sector, or slice of the market, and that is a lot of the popular tech and AI. It's not all tech and AI, but it is a lot of tech. They're forecasting a slightly negative return to a positive 1.6. That is a jarring forecast and difficult for many to wrap their brain around. And then drawing your attention down here to, call it, foreign assets or global companies ex-US, forecasting a relatively average rate of return in alignment with its historical average, that 7 to 9, give or take. Down here along the bottom, these are popular areas of the fixed income or bond market. And the general consensus here is that, hey, you can expect somewhere north of 4% in most categories here. And the bond markets are easier to forecast because part of it's just math. If you buy a 5.2% bond and hold it to maturity, you're going to make 5.2%. So this can be forecasted with more accuracy. The key takeaway, though, from this, again, no one knows what the future has in store. But if this were to play out somewhat along these lines, we are talking about a complete role reversal of the last 10 years. Bonds basically outperforming the most popular areas of the US stock market. You go, well, how could that possibly happen? It has happened in the past. So it's not unheard of. It happened in the 2000s is really the most recent stretch, but it has been known to happen. So this is one of those guide for the future. Keep this in mind, proceed with caution, because mean reversion, to what Tom mentioned before, does occur.
Yeah, and this was underscored, I think it was just last week, Casey, James Bianco, the market commentator and very well respected observer of all things, particularly relating to the Fed. He picked up a piece that Mr. Buffett, Warren Buffett, had written in 1977, and he put it on his site. And it was a great read of Warren Buffett's observations in 1977, just as the shift from fixed income to equities made sense, meaning interest rates were peaking right around then, and equities started to come out of the shadows. So it's worth reading from a historical standpoint that Warren Buffett liked bonds at one point, and then talked about the equity markets. And right now, Warren Buffett and many other investors are sitting on large sums of cash because they don't see valuations as attractive in the equity markets right now.
Mhm. Yeah, a lot of cash on Buffett's balance sheet. So continuing with the key themes for the future, I'll call it going a little more granular from that last page. Looking at small caps, small companies. This chart reflects valuations of global small caps when you look out at the world. And what you can see here on the right-hand side of the page is that global small caps, their valuations are near multi-decade lows relative to their larger counterparts. And especially small caps overseas are what we would consider, of value because of how the strong dollar has impacted total returns overseas. Now, need to be careful with how we say this from a compliance perspective. For more aggressive savers and for those who have a higher risk tolerance, and for some of you, this has been an area where we've been adding to the last few years because of its relative value and the long-term outlook. Not everyone's situation is different and unique, and we also need to take into account the tax exposure as well. So, Tom, anything to add on this one before we flip to the next?
No, just an interesting fact that some of the small companies are starting to pay dividends earlier in their lives than they had in the past. That's the other reason that in many cases we may be, given the circumstances for the client, we may be adding some small cap exposure for some of our older clients if it fits their profile, because now they can get dividend yield as well.
Yeah. If we look at smaller companies on a domestic level and kind of continuing with this small cap theme, this chart dates back to 1938, and it gives you a sense of how small companies have either, call it, outpaced if you're above the line, or underperformed or underpaced, again, your larger company counterparts. And what's unique about small caps and their history of performance is that they tend to underperform during unique periods of innovation. And we're certainly living through one of them right now. And sure enough, small caps have again underperformed slightly. Historically, they have then gone on to outperform in pretty dramatic fashion. And this is kind of coming back to what we mentioned early on. Tom, you just mentioned that small companies are now starting to pay higher dividends. Private equity is now more involved with small caps and small companies today more than ever. Tom, do you want to share a little context on that?
Well, I just think private equity, because it's been so popular, and I think private equity in many respects for the last decade has been distorted by low interest rates. What we don't know yet is how the markets are going to evolve and how private equity is going to evolve with the more normalization of interest rates.
Yeah, and we've seen a lot of companies, instead of coming to market as small caps, private equity has been gobbling them up and then releasing them back to the public markets as mid caps. So in some ways, the mid cap space is also, from our perspective, attractive, similar to small caps because of the quality of the company that is now entering into that space. And so We are going to change gears, moving away from the equity markets in general, at least domestic equity markets, moving over to the bond market here. And the bond markets as a whole, in general, remain appealing. Okay, yields remain very attractive. We showed you how the yield curve and how interest rates have come up. We are looking at starting yields akin to what we saw 15, 16 years ago, especially within the municipal bond segment of the bond market for those that are in upper tier tax brackets. So what you can see here is 10-year treasuries starting at around 4.6. High quality munis. This is a taxable equivalent yield. So this is as if you're in a 40% overall tax bracket, but starting in the mid fives. Investment grade corporate bonds, munis, high yield, all of these look attractive for those that are either conservative savers, for those that need income from their portfolio to live off of, and even just a conservative sleeve of one's allocation. Not to mention, this is very helpful for insurance companies, endowments, state pensions, and to what we've talked about in the past, the world has been starving for yield for the better part of the last 14 or 15 years. And the bond market in general usually doesn't get the love or the appreciation that in some ways it deserves. We wanted to showcase that here today.
Well, and I think it's also worth noting because you highlight municipals here, those are the tax exempt component of the bond market. If tax rates go higher, municipal bonds only become more attractive, not less.
Yeah, and especially, I mean, should Vanguard's forecast prove to be true to some extent, these yields suddenly look very attractive compared to the volatility ranges of some of your more popular areas of the stock market. So this is deserving of everyone's attention to some extent. And also, another area of the market that often doesn't receive the appreciation we believe it deserves are the dividend payers of the world. This is a chart that we actually used a couple years ago to showcase how dividend payers looked relatively cheap compared to the index as a whole. And you can see since then, sure enough, they have appreciated. This is also taking place as returns begin to broaden, as we mentioned earlier. But dividend payers remain core components of almost every investor's allocation. So whether somebody be in their accumulation years and benefit from compounding, which we've titled the eighth wonder of the world again. That's not our line, but it's something to always keep in mind that compounding is magic. And whether you be in your retirement years, dividends help feed those distributions that you are thereby living off of. And historically, dividend payers have traditionally held up a bit better than other areas of the market during downturns. Not always, but historically tend to have some stronger balance sheets. So this is certainly an area of the market that we continue to pay attention to and continue to find attractive.
And to Casey's point, this is an area that we will often be introducing to our clients before they may be approaching retirement, just to start to tee the asset class up in their portfolio so that when they do eventually want a distribution from their portfolio, meaning they want the income or they want distributions on their total nest egg, that the dividends are there to pay them.
Yeah. And no conversation would be complete here if we didn't mention international markets. We have changed up the slide from the last two, but we do want to adjust our attention to international equities and foreign exposure, which I think, as I mentioned earlier, up until the election in 2024, foreign markets were on pace to have a very strong year. They reversed course and gave those returns, or much of those returns, back, again, as concern about tariffs and a strong dollar. But want to take a moment, or want to provide a moment for you to digest this. It's a busy page, and walk you through it real quick. It shows total equity returns in various countries by decade. And you can see the 70s, 80s, 90s, etc. And it lists the top performing country versus the worst performing country. And I think to many people's surprise, the US has only led the rest of the world in 5 of the last 11 decades. And when we look out at foreign equities today, foreign equities have never been cheaper relative to the US, which is, quite the statistic. And Tom, I read actually earlier this week that the US market cap is now around 75% of global equities, which the last time the US made up that size or that weighting was in 1969, literally on the cusp of the Nifty 50, the last time the US was deemed to have been the dominant decade to come. And I think the Nifty 50 was down around 95% 5 years later.
And that period that followed that was dominated by many of the foreign countries, particularly Japan.
Exactly. So this is just a reminder that regardless of how foreign equities have performed over the last couple of years relative to the US, they continue to deserve a place within most portfolios, especially when you think about, Tom, dividends, compounding, and income, because of how they're known for generating oftentimes 2 to 1 in terms of income yields or dividend yields compared to the US. So,
Very true. And folks that are looking for income, if they don't have a foreign component, should be looking to that.
yeah. All right, second to last page here. Love the tagline up here. There are two types of forecasters, those that don't know and those that know they don't know. And this is the infamous quilt chart. And as Tom likes to say, quilts provide a warm and comfortable feeling. And in this situation, now it's a matrix or it's a quilt of the best to worst performing assets in any given year. This is also a busy page, so I want to give you a few minutes to digest it, and we'll break it down as if we are sitting one-on-one with one of you and explain this. So if we were sitting down with one of you, we would start at the top, give you a sense of it shows annual performance. Again, the top box is the best performing, the bottom box is the worst. And this chart here runs all the way out from 2010 all the way to the right to 2024, all right? Now we're gonna, for the sake of this example, we're gonna use small caps just because we have been talking about small caps. Small caps in orange, you can see they had a great year in 2010, negative, good, great, negative. Work your way across the chart, okay? You can see there's some great years in there, and there's some not so great years in there. And when you average it all together and you look back from 2010 to 2024, small caps delivered an annualized return of around 10.3, but notice the volatility metric was also at the very top of the list. Now draw your attention to the white box. The white box represents a disciplined and diversified process, asset allocation, a lot less volatility when you work your way across the chart over the years, strong performance, and much less volatility as a whole. All right. Now, if anybody from today's conversation that's listening, if you know what color or what asset class is going to perform best in 2025, we welcome your call after our webinar. We are all ears. But in reality, nobody knows. And this is the importance of diversification. And the big takeaway from today's call is, in fact, the importance of diversification. We see incredibly rich valuations in the most popular areas of the US market. All right, bonds have had a tough stretch, but have very attractive yields looking ahead. You add in a layer of geopolitical uncertainty, and if there was ever a time to maintain discipline and diversification, now is it. And this is that reminder to everyone that it's really important.
And I think it's also worth noting for those of us that, and we all have them, we have friends that like to brag about their CD yields are now a whopping 5%. And CDs are basically cash, but look at how few times cash has been the best performing asset class going back in time. And this would hold true going back 30 or 40 years too. So cash may feel good, but it's not a great long-term asset class.
Yeah. Commodities gave it a run for its money, but fell short.
Yeah.
All right, last page here. And we thought we would take a few minutes, we know we're winding down, to discuss a few key themes for the future, but from an in-house perspective. Work that we're doing based on your goals, your evolving needs, and with an eye towards the future. So we're going to discuss these categories in blue. And the first one being the importance of tax efficiency. This has been an underlying tenet of our practice, Tom, since you founded it 40 years ago. This is something we talk about almost every day in one shape or form. And so over the last couple of years, especially, we've been integrating from a portfolio management perspective, direct indexing when it comes to the strategies themselves. Direct indexing, highly customizable investment strategies for those in upper tax brackets. For the last couple of years, we've been replacing active funds with active ETFs to mitigate capital gains distributions at the end of the year and improve tax efficiency. Asset location is a theme. Again, it's a matter of where you locate positions based on its future tax exposure, and continue to incorporate tax-exempt strategies where it's important. Tax and estate planning, we're having annual assessment of savings strategies and distribution strategies, oftentimes in conjunction with one's accountant. Roth conversions, we now call October 1st through the end of November Roth conversion season, because just the sheer number of them that we're evaluating, and then more sophisticated strategies like slats, et cetera, while the exemption limits here remain very high relative to history. We're also doing a lot of work on the charitable front involving donor advised funds, qualified charitable distributions, and more sophisticated planning like CRATs and CRUTs. All right, so always evolving here and more to come. When we think about, we talked about AI earlier and all the change to come. Well, we have been incorporating AI into the process and into our practice over the last few years. From a portfolio management perspective, we've incorporated some AI as it relates to improving tax efficiency and reducing tax drag over time. Some of our financial planning tools now have AI components to be able to better stress test scenarios and correlations. And then we've been evaluating different AI-related software, some of which involves scanning tax returns and estate plans, and very quickly having some summaries and recommendations. We're currently evaluating a communications platform that would provide you access to paywall content from the Wall Street Journal, Bloomberg, and other publications. And then lastly, we're evaluating some back office solutions that allow us to deepen our service model. So a lot is going on kind of behind the scenes as it relates to being able to continue to deliver value. And then lastly, the last category here, we reflect on how much has changed over the past 10 years with our clients, their lives, goals, needs, family, loved ones, friends. We talk about it internally in terms of how much has changed within our own team. And then we think about how much will likely change over the coming decade. Tom, you've used the tagline, demographics are destiny, as they say. And on that front, our team has been increasingly engaged in multi-generational efforts, working with the matriarchs, the patriarchs, and the adult children. We're putting together various resources to help with longevity planning, housing and healthcare related transitions, and with the goal of helping everyone in this call preserve their agency and control or retain control over their own future, and ultimately live well and help those we love. So stay tuned for more on this front. If you have any questions regarding your own circumstances or loved ones, please let us know. So with that, that brings us here to the end. Quick summary before we open it up for questions. Kind of looking back, well, the AI story continues to unfold, and though other forces are shaping the landscape and market returns are beginning to broaden. We think about important context. Well, U.S. valuations remain historically high. Beware of the groupthink. Change is constant, and interest rates may ultimately influence the impact of economic policies. And then we think about key themes for the future, and it's really that patience and discipline are the cornerstones of successful investing. And also really embrace the change. There's a lot of change to come, whether it be personal or professional, over the coming decade. The bottom line here, again, patience and discipline are the cornerstones of successful investing. please tune out the rhetoric. There is going to be a lot of it in the coming months. Do your best to tune out the noise, and as we said, prepare for change. And then next steps, we always ask, please do your best to digest our monthly updates. We know you're busy, so you're not going to catch them all, but when you can, don't hesitate to schedule time to discuss any questions or concerns. Please share your knowledge and communication with people that you feel may benefit. And then lastly here, do not forget to be kind to your accountant this tax season. They are already overwhelmed. We've had a few conversations recently, or they are in full go mode of 60 to 80-hour weeks already. So please be kind to your accountant this tax season. And with that, we will open up the lines for questions. We ask that you use your first names only. And as we wait for questions, we are going to satisfy compliance by flipping through the next few pages of disclosures. So bear with us as we wait for any questions. So, and I say wait for any questions. Brittany, as kind of one last reminder, we're about to send an email update tomorrow night. Brittany Beard is on maternity leave. She delivered a healthy baby boy a few weeks ago. And so while I say we're going to open this up for questions, we hope that you have access to it because we were the ones that set this up instead of Brittany this go around.
Bear with us over the next few weeks while Brittany's out too, because tax season is normally our busiest time of year. And being down one set of hands means we're all carrying an extra load of water, but I think we're doing okay.
Yeah, and again, then tomorrow night we are going to be sending an email with tax document schedule, so everybody knows when to expect what as we move our way into tax season. So with that, let's see if we can address any questions. I do have a Q&A here. All right, we have one here, Tom. How will Trump tariffs affect our portfolios? What do you think, Tom?
Unknown right now. A lot of the noise, a lot of the campaign rhetoric, it's too early to tell how much of it's really going to be brought in to become policy. So far, given I think some of the missteps, we have to be more careful about what is said versus what is really implemented. Tariffs in general are viewed as inflationary. We talked quite a bit about inflation earlier in the program, and we do think inflation could potentially tick up if the tariffs are implemented at the levels they were talked about. But remember that ultimately tariffs are paid by somebody, and some of it's going to be paid by us, and that's the inflationary component. So we have to be careful to see what is rhetoric and what is reality. And right now, it's too early to tell. I'm sorry to say.
Yeah, Tom, I'll piggyback on that real quick. And that's, what I've said often is our biggest concern prior to the election remains our biggest concern to some extent, and that is how rich valuations are today. And what has maybe been surprising is throughout January, foreign markets are actually off to a pretty good start. Now, they're up 5-6% year to date, I think, as of this afternoon. And part of it is because the concern over tariffs so far may have been greater than the tariffs that are being discussed currently. So the markets are always very forward-looking. And oftentimes what we know today has already been digested.
And for those of you that are interested in some of the tariff commentary and such, there's a gentleman, actually a New Hampshire native, who's a very prominent professor at Dartmouth named Doug Irwin. He's been quoted quite extensively, Financial Times. He's been quoted in the past by the Wall Street Journal. He is kind of the expert on international trade, just happens to be our friend and neighbor. But read Doug Irwin if you want balanced, unemotional commentary about what tariffs could do.
Tom, we have another one coming in. What is the role of China with respect to volatility? The history of the dot-com bubble, 90% reduction in cost of new AI. There's the deep sea question. I knew one would occur.
And I actually thought it might come from that person. So, attaboy. So there was an incredible program that I had the pleasure to listen to. I think it was yesterday about DeepSeek, et cetera. Again, I'm sorry to say that the answer is going to be too early to tell. What DeepSeek showed us is that AI may not need a super chip created by NVIDIA. It may be attainable through other technologies. That's not necessarily a bad thing unless you put all your money in NVIDIA, but it may not be a bad thing. So I think it remains to be seen how this is going to play out. But innovation's always been disruptive, and I don't think this time around is going to be any different, quite frankly.
Tom, I think you mentioned a great example earlier too, when you mentioned Netscape. You think about some of the early technologies surrounding the excitement, the MySpaces. I forget the music platform, that Napster, something along those lines. But a lot of those really exciting newbies don't end up being the primary 10, 15 years later.
On a general basis, though, just like the internet was, technology can be deflationary or disinflationary. So it may actually help keep the costs of goods and services lower.
And that's how it works its way into earnings of other industries, sectors, and companies.
Yep.
Yeah. All right. Anyone else here? All right. If anyone has any questions, please don't hesitate to give us a call. Wait, hold on. We've got a question here. Are we concerned about any of the radical changes coming from the new administration?
I think the question is specific to the mass firing of the inspectors general. That is troubling. I'm not going to perfume the pig. I just ironically had just finished a book 2 weeks ago by Glenn Fine, who was the inspector general for, I think, the Defense Department, the Justice Department, and one other during his tenure. And the inspector general was an office created in 1978 by Congress to make sure that we were spending our money wisely, and therefore there was accountability. Removing accountability in anything is troublesome. So we've yet to see how it plays out. The termination of some of these inspectors general is supposed to be with notification of Congress. That did not apparently occur, but we have yet to see how Congress is going to respond to that. But if you want a great book for your bedside table, I'll be glad to loan you. It's called Watchdog. It's sitting right there. And it was a fascinating read because I didn't know about the Inspector General Act in 1978, and I bet many of you didn't either.
All right. Anyone else here before we wrap up? And again, any questions that anyone may have, please feel free to send us an email. And once everything is officially approved by compliance, we will do our best to disseminate it through email and also post it within our website. So with that, then, again, on behalf of everyone here at Clove Hitch, we cherish our responsibility. We appreciate your trust. We are always in your corner. And whatever we can do to help, please don't hesitate to ask. Thank you.
Thanks for being here today.